Assalamualaikum and good day to Madam May Sapura. We are Group 3 who would like to present on the case study of Enron Corporations.
My name is Nurul Izzah Najamiti Hamidun and I'm about to present Chapter 1.1, the introductions of the Enron Company. Enron was formed by Kenneth Lay in 1985 by merging two natural gas pipelines companies. At the time of merger, Enron owned 35,000 of intra- and interstate natural gas pipelines, while also trading natural gas. Enron Company has been announced as the world's largest natural gas trading company. Following from the deregulations of sale of natural gas, Enron experienced increase in revenue and became the largest natural gas trader in North America in 1992. Furthermore, Enron Company is also one of the 5 largest audit and accountancy partnerships in the world. In addition, Enron was the 7th largest U.S. corporation in year 2000. When Enron was rated in Fortune Most Admired Company survey as the most innovative large company in America. But Enron Company was also known as the largest bankruptcy and stock collapse in the United States. On December 2nd, year 2001, Enron filed for bankruptcy, which was the largest in the United States history. Moving on into the issue of the case. The Enron case is one of the biggest corporate scandals in recent years. It involved a number of corporate governance issues, whereas I would put it, what could go wrong did go wrong. The company turned from an acclaimed company into the most infamous company in the world overnight. Let us now take a look at the issue. First issue is incompetence of the board of directors. In this case, they practice in unethical ways and occurs conflict of interest. The second issue is in auditing and accounting. For example, like accounting fraud and accounting malpractice. Next, the statement of the problem of Enron case. The case study shows the downfall of a company's success due to its unethical working personalities whom have the negative traits of negligence, malpractice, and unawareness when it comes to ensuring the rise of a company's stock market rate. The last part for this chapter are about the discussion question and followed by the discussion objective. We have 2 discussion questions and 2 discussion objectives. The first question is, does the board of directors exercise their roles and responsibility efficiently in managing the companies? The discussion objective for this question is to analyze the factors contribute to the unethical behaviors of management in the company. The second question is, does Enron had committed accounting fraud in providing false information to the investor in order to hide bad financial performance of the company? The discussion objective for the question number 2 is to discuss whether the roles of the auditor is performed successfully and in compliance to corporate governance.
Assalamualaikum warahmatullahi wabarakatuh. My name is Shauna Fitriani. Now I'll continue with chapter 2, which is literature review. Core concept of corporate governance consists 4 items, which is transparency, integrity, accountability, and independence. In transparency, it means open and clear disclosure of the information to the shareholder and the stakeholder of the company. Secondly is integrity, straightforward dealing and completeness. Thirdly, accountability means director and organization are answerable in all of their action. Lastly, independence means free from conflict of interest. Next is director. The definition of the director already stated in Section 2 of the Company Act 2016. For board independence, in MCC 2021, the board that comprises a majority of independent directors will make the management more effective. Then, not only the background and the current activity qualify him or he as an independent director, but the director must act independent on their management. RISI 2009, the quality and quantity of independent director on the company board play an important role in ensuring the board effectiveness. In the term of quality of director independence, the ability of the director to act independence are more important than the number of the independent director. In the Company Act 2016, Section 213 states that the director need to exercise their power in good faith in the best interest of the company. There are 3 categories of the duties of director. Firstly is fiduciary duty. Secondly is duty of care, skill and diligence. Lastly is statutory duties. Role of board of the director. In Security Commission, the board has the responsibility to set the tone and standard of the company through the Code of Conduct and Ethics. The Code of Conduct and Ethics will give them the guideline in the behavior of director, management, and the employee. Refer to the Company Act 2016 in Section 245. The account of the company are sufficient to be kept and the transaction and the financial position of the company can be disclosed for the auditing. Next is Audit Committee. In MCCG 2021, Practice 11.1, the Audit Committee should ensure that the internal audit function is effective and able to function independently. In Listing Requirement 15.10, Chairman of the Audit Committee, the members need to select a chairman among themselves who is an independent director. In Security Commission, all members of the Audit Committee need to make a continuous professional development in accounting and standard auditing, practice and rules. Next is Auditor Independence. Auditor independence means that the auditor needs to be independent in mind and the appearance. The state of mind that allows an individual to express an opinion without being influenced by other factors. The avoidance of fact and circumstances that are so significant that are reasonable and inform the third party and having all the relevant information. Next is Internal Audit. In MCCG 2021, an internal audit function helps a company to accomplish its goals by bringing an objective and disciplined approach to evaluate and improve the effectiveness of the risk management, internal control, anti-corruption, whistleblowing, and the governance process.
My name is Zairaini. I would like to present about the application for the case study. So for the first discussion questions, it is relating the roles and responsibility of the board of directors. So there is an unethical behavior in the board of management and also the application of non-competent person being practiced in the Enron. So board of the directors need to practice the 4 core concepts of corporate governance, which are transparency, integrity, accountability, and also independence. So from the case, we can see that the chairman of the board, Kenneth Lay, and CEO Jeffrey Skilling allowed the CFO and Andrew Fastow to build private corporate institution secretly and then transferred the property illegally. The CFO Andrew Fastow violated his professional ethics and took the crime of the malfeasance. The boards should be more transparent in managing the company. There should be a healthy corporate culture in the company. The whole corporation actually are not responsible for the scandal for every scandal that happened in the company. So the board should pay closer attention on the behavior of the management and the way of making the money. Next, in Section 245 of Companies Act 2016, account of the company shall be kept in manner by the company directors or the managers. But in January 10, 2002, the employees of Enron had destroyed some of the documents and correspondence related to the Enron engagement that brings to the most damaging to Anderson's reputation. Next, for the Enron scandals that happened, the directors should exercise their powers in good faith by following the 3 categories of duties, which are fiduciary duties, statutory duties, and also the duties of care, skills, and diligence. So, Trigger 2013 believed that conflict of interest arises if a director could benefit personally from a situation involving the company or from a decision taken by the board. There is breach of fiduciary duties of the directors by conducting activities according to their own interests and lack of independence oversight to the management conflicts and interests by Enron's board contributed to the firm's collapse. Skilling is lack of interest in company's management where when he was appointed to be the COO, he made a poor situation worse by making bad management appointment. The second discussion questions, does Enron had committed accounting fraud by providing false information? So there is a lack of transparency on financial report statement by the audit committee that leads to the breach of code of conduct and ethics. The auditors had window dressing the company's account by providing false report that company actually making loss. It is because they think it is incompetence for the company to attract the investor with bad financial statement. So they show the false informations in the financial statements. Enron used sophisticated techniques to keep its share price high and maintain. For the mark to market, in order to keep appeasing the investor to create a consistent profiting situation in the company, Enron traders were pressured to forecast the high future cash flow and low discount rate on the long-term contract with Enron. Meanwhile, Enron also effectively admit that it had inflated its profit by cancelling debts in its complicated partnership agreement, which is a special purpose entity. So, Enron used special purpose entities to decrease the losses, enlarge profits, and keep debt away from its financial statement in order to enhance its credit rating and to protect its credibility in the market. So, from this, the investor will keep on investing in the company without knowing that Enron actually had a bad financial statement. Next, from the MCCG 2021 Guidance 11.1, an internal audit functions help a company to accomplish its goals by bringing an objective and disciplined approach to evaluate and improve the effectiveness of risk management, internal control, anti-corruption, whistleblowing, and also the government process. So, and from the case study, Enron had covering up their losses when there is existed failures and losses happen in the company. The clear information also was hidden from the investor, that forcing the investor invest invest millions of shares in the company, that it also resulting in the losses due to the fall of Enron. This was explained when several of the company's investors were surprised by the news about the misappropriation of the Enron's company's account that brings to the danger of the company. The complaint was brought by the Sharon Watkins, business development executive of Enron, who wrote a letter for Kenneth Lay as a whistleblowing warning. So here we can see that the internal audit should play their roles and functions in order to ensure that they can improve the effectiveness of risk management, anti-corruption, and also the whistleblowing. The audit committee also need to ensure that the internal audit function is effective and able to function independently. So there is a conflict of interest and malpractice that happened between the roles played by Arthur Anderson, which is he played the role as an auditor and also as a consultant of Enron. So malpractice happened when Arthur Anderson did not conduct their duties well accordingly to industry specifications by conducting unethical practice in regulating and handling companies and shareholder interests. Management of Enron also returned to refuse to maintain the reality that led to the accounting fraud in which auditors, analysts, banks, and regulators turned a blind eyes to the situation. So here we can see that a person cannot hold two roles at the same.
Hi, my name is Nur Ain Shazana, and now I will explain about recommendations and suggestions for Enron. The first suggestion and recommendation that can be used from the case study is Enron can adopt the implementation of internal control. Internal control can be described as the controls seeks to guarantee that risks or variables that impede the fulfillment of a company's goal are reduced. Relating this to the MCCG 2021 Guidance 11.1, an internal audit function helps a company to accomplish its goals by bringing an objective and disciplined approach to evaluate and improve the effectiveness of risk management, internal control, anti-corruption, whistleblowing, and governance processes. In addition, an internal control system is the entire network of mechanisms developed within an organization to offer reasonable confidence that organizational goals will be fulfilled. In addition, internal controls are also the measures and procedures put in place to protect the company's asset, verify the accuracy of its accounting documents and discourage and minimize fraud and theft. Internal control initiatives should be evaluated and revised on a regular basis to ensure that they are effective and keep up with the emerging and other breakthroughs. On top of that, a professional such as an expert can also be appointed by the organization to establish the company's strategies and processes, offer effective initiatives, and assist in their implementation. An internal control system is designed to avoid errors and fraud and to track corporate operations on a regular basis. An action that was done by Arthur Andersen in Enron is that he was the person responsible for all the accounting fraud and the window dressing of the financial statement. The second suggestion is that Enron may develop a clear policy addressing conflict of interest is the approach for Enron to limit, moderate, and manage the problem in the incompetent board of directors. Typically, a business dispute of interest often refers to a situation in which a person's personal interests collide with his or her employer's or the company in which it is accrued. This can be seen where Arthur Andersen is in the middle of the conflict of interest as he plays two roles in Enron Corporation, which is as an auditor and consultant as well. To avoid any disputes from arising in a corporation, they should create a set of regulations by which a firm and its board, staff and contractors are prevented from conflicting interest rates. On the other hand, Enron must ensure that employees are aware of the company's policies in all these areas when dealing with potential conflicts. Conflicts may be perceived impossible or important from the perspective of a Chief Compliance Officer (CCO) and must be addressed appropriately. However, interest conflict can bring severe damage to all organizations ineffectively or inadequately handled. This is why it is critical to establish and build a clear policy addressing conflicts of interest to guarantee that they do not negatively impact the firm. Finally, the third suggestion is creating a code of conduct and code of ethics is the way for Enron to manage the situation. Under Practice 3.1 in MCCG 2021, it highlights that the board develops the company's code of conduct and ethics and executes its policies and procedures with management, which include the management of interest dispute, the avoidance of abuse of power, bribes, insider trading, and money laundering. In addition, Guidance 3.1 of MCCG 2021 mentioned that in the code of conduct and ethics, the board is responsible for determining the company's tone and standards. The Code of Conduct and Ethics should clarify and guide managers, management, and the staff behavior. The Code of Conduct and Ethics rules should be included and evaluated frequently into corporate management processes. We need to keep in mind to include important workers in the process of developing and formalizing the Code of Ethics. Include important workers in the development and formalization of the Code of Ethics. It will ensure that leaders understand and are committed to the values. Furthermore, the company should establish a written code that outlines clearly both the needs of the employees and what is not acceptable. In a nutshell, it is vital to update the ethics code to maintain a corporation's ethic at the forefront. Lastly, to reduce unethical behavior and the demise of your corporation, the code of ethics should be continually promoted, controlled, and updated.
For the conclusion part, Enron Company was a massive failure which shook the entire United States economy, where the action is still viewed as an immoral practice in business because fraudulence is the underlying purpose of carrying out this action. With the enforcement of the solution, important for the company to encourage transparency and ethical practice. This means that the authorities realize that the ethics and internal controls in business are relevant. Next, it is really important in understanding the roles and responsibility to avoid the conflicts of interest and breach of duties. The solution gives the advantages to the Enron to control and reduce the problem that they have been, such as disclosure on the financial report to the employees, implement internal control, develop a clear policy regarding the conflicts of interest. The result is an increase in the effectiveness of the internal control.